Welcome to the Common Fund Point of View. I'm Anita Harrington, Head of Client Engagement for Common Fund OCIO, and I'm joined by Chris Quaid, Chief Investment Strategist. In this podcast, we look to share our latest views in 15 minutes or less. So let's get right to it. Chris, let's start from a macro perspective. What does our dashboard currently show, and has anything changed since last quarter?
Thanks, Anita. If you look at our dashboard, and I won't spend too much time here, but going into fiscal year end, there were no changes to the 7 primary factors in our tactical dashboard. However, there were a few minor changes to some of the underlying indicators. We have about 50 that roll up into our factors. And so, for example, just to share a couple, we're seeing less favorable equity risk premium during this rise in the markets, meaning bonds are becoming a little more attractive relative to equity risk. And we're seeing some of the economic surprise indicators get weaker. But overall, growth continues to be fine, not exciting, but earnings are holding up. And inflation really continues to soften, and it's coming down. And we do believe it will continue to come down as we look forward. But it's still obviously above the overall goal for the Fed of 2%. And employment is good, but clearly softening. It looks really healthy if we just focus on the monthly, like Bureau of Labor Statistics data, which is backward looking. But if we look at more current data, like job openings, like job cuts, and sentiment in the job market, right, we'd expect to see more weakness in the jobs data. And the evolving narrative seems to be that people feel less secure in their current employment, and finding a new job is becoming increasingly more difficult. And in terms of Fed policy, as folks listening on this call know, since the beginning of 2024, investors have had to embrace a less accommodative FOMC. The expectation of 6 rate cuts has dwindled really to the hope for maybe 2, maybe 3 in 2024. And in fairness, we believe this holding off by the Fed is warranted. Ultimately, domestic growth has really been supported by the consumer, and companies have been able to pass on these higher costs and preserve margins by taking advantage of consumers' willingness to spend. But as we look at the data now, savings have dwindled, the costs of revolving credit are building, and absent fiscal stimulus, the last source of real comfort is job security. And so if unemployment begins to rise, and we would expect to see a significant downdraft in consumption and growth, and that should motivate the FOMC to reduce rates. So as a result of mixed data and a lack of clarity around near-term market drivers, what we did was we rebalanced our discretionary portfolios back to policy end of the fiscal year. And so essentially, for the most part, we sold some equities into strength and bought some bonds.
So based on that information, then, how do we analyze the Fed, and what is our goal in predicting future movements and making future portfolio investment adjustments?
Yeah, so I think first of all, important in our philosophy, we don't fight the Fed, and we believe that the Fed's been very clear in their communications and deliberate in their process in terms of adhering to this dual mandate, both inflation and unemployment. And we also think that the Fed's being humble about the fact that this is a tough environment to navigate. But we do believe very much that they care about both mandates, and more so now versus previously because of this recent rise we're seeing in unemployment. So, based on that, we continue to believe the next move in rates is lower. We've been saying that. We believe inflation, is trending in the right direction, and this fear is really somewhat turning to unemployment. So we do think there'll be a cut in September, and we can also see that the market is really giving this to the Fed. You can see that in Fed fund futures, and you can see in the fall the 2-year interest rate. Right, so the market's telling the Fed, you can cut. And but any additional action in the fourth quarter is also pretty likely. But of course, we think that's going to depend on the data the Fed gets.
So, is there any hope that the Fed has or will achieve the soft landing that we've talked a lot about? And are there any recessionary fears now off the table?
So it's it's awkward a little bit because we need to question, of course, what a recession um, is, and by definition, it's back-to-back quarters of negative GDP. So yes, we may avoid that, and we may avoid what we would call like a technical recession. But if we have a bad rise in unemployment, it'll feel like a recession to many. Um, but if we do have a technical recession, we don't think it'll be severe. So we do have hope. And I think this looks like the makings of a soft landing. But recessionary fears, can't completely come off the table. Um, you know, but most importantly, we do believe if we have an employment recession, right, it'll force the Fed to be more aggressive and to help save things.
So, given those views, how are we thinking about interest rate risk and duration in our portfolios today? I mean, are bonds really attractive in this current environment?
So I know bonds have this year bonds are doing okay, but I know bonds have had a few tough years. But bonds perform well in a rate cut environment, and so we view interest rate risk as attractive at this point. And one way I like to think about it is if the economy stays where it is and it hums along slowly, right? Bonds should give us a nice yield, and a nice yield not just in absolute terms, but a nice yield relative to the cash flow we can get from equities right now. Equities aren't cheap. And if we have a significant slowdown, then we can benefit from the cash flow and the interest rate risk of the bonds, right? As rates would come down and we get a good amount of capital appreciation. So yes, we like bonds here. And we also like the interest sensitive parts within our asset allocation.
So, over the last couple of weeks, a lot of changes to the US election landscape. Any comments on how we're thinking about the US election, Chris, in terms of debt burden, taxes, trade, and how different policy approaches could impact the markets depending on the outcome?
Ultimately, there's going to be a lot to think about and analyze here and put into our modeling efforts. But but up front, we don't try to forecast election outcomes. We also don't try to forecast policies because we don't think we really have an edge in that. We don't really think anyone's very good at that. And instead, what we'll do is we'll look at the actual outcomes and approved policies and think about how that impacts the markets. But in recent weeks, we are getting a sense of who the candidates are. In terms of debt burden, neither party is really addressing it. It is a big issue. Neither party is addressing it, though. In terms of trade, I think both parties are adopting, to different extents, to a more protectionist stance with regards to tariffs. Taxes, how that gets resolved really remains in question, but it'll be a big legislative issue in 2025. And we do think there will be impact on energy and on healthcare, if I had to pick two areas based on different policy outcomes. So after Election Day, we're going to have to take a hard look at our outlook, and we're going to have to think about how it impacts not only the equity market and earnings and growth, but also how it impacts fixed income markets, particularly U.S. Treasuries, and thinking about this debt issue. And we have to think about the relative strength of the dollar from a trade perspective. And this is stuff we'll all share, of course, but on a broad level, this is one time going into the election where on a lot of the issues like debt, like trade, like tax, it's there. We don't have a big polarizing differences, and so we're going to see how that data comes out.
Well, that's a wrap. Chris, as always, thanks for your insights. I look forward to our next conversation.
Thank you, Nia. Thank you, folks.